So let's go ahead and get started. Okay, so what's new going from 2023 into 2024? The first thing I will note is that there is a full year appropriations bill that's still pending in Congress. I'm not certain how many people have been paying attention to the news in Congress, but there was supposed to be kind of a resolution to this issue. It got extended. It was supposed to get done last year. It got extended to January 19th. They realized they were going to be unable to come together on a full year appropriations bill. So the new extension now takes us to March 1st. I will note, though, that if they're unable to agree upon a bill or an extension by March 1st, then the government will shut down. So there's a shutdown deadline. That shutdown would include the IRS, and never before in the history of the United States has the IRS actually shut down during the tax filing season. Prior to the Inflation Reduction Act, which is the IRA, there was a contingency plan for shutdowns that the IRS issued. And in that contingency plan, they did indicate that if they were shut down during the tax filing season, that they would deem roughly 57.6% of their employees as essential employees. So a good chunk, would be deemed essential, but still there would be a chunk that would be missing. And it's unknown how that impact would affect, tax returns and tax filing. I would also note that the IRS defines tax season as January 1st through April 30th. So, for example, if the government were to shut down on March 1st and stay shut down, after April 30th, then the number of essential employees would then drop down to 39% under the 2022 contingency plan. So we would see a drop in service significantly after April 30th. Some other things to note, there are kind of two tax bills globbing their way through Congress that are kind of coming in alongside the appropriations bill. And I bring this up because a lot of the provisions that are in these bills, the Tax Relief for Americans Families Act, for example, they are related to 2023, meaning that if this legislation is passed, and it's passed sometime after Monday, because Monday is the start of the filing season, which we'll see here in a second, there could be people that file tax returns and then have to go back and amend tax returns to include this updated law because things have changed, and specifically related to maybe the child tax credit or some of these other credits that they're talking about here. As we know it right now, the Senate has scheduled a 2-week recess starting on February 12th. And the House isn't scheduled to take up any appropriations bills the week or next week. So it's a little bit of a weird timing process between the House and the Senate to consider any bills, any that will go for any new tax codes, in addition to the appropriations bill to fund the government. Long story short, there's no way that we're going to get anything that's going to be in place before January 29th, before tax season opens. And again, there's going to be kind of a timeline where if this is passed, it will go into place, will be signed, and then it's not like it's instantaneous that's going to show up in the tax software. It's going to take time for them to trickle down to the IRS, and then from the IRS to the tax return service providers. So long story short, some of these new provisions that you're seeing here, if they pertain to your tax return, they may cause you to have to file an amended tax return sometime in March or sometimes thereafter if you've already filed, or potentially delay your tax return from being filed timely on April 15th. The second big act that's floating around is the Death Tax Repeal Act, and it's picking up a little bit of momentum. I wouldn't say it's enough to consider that it could get passed, but basically what's happening here is they'd like to eliminate the U.S. estate tax and the GST tax. So those two taxes are basically on the chopping block. If this were to be passed, then as of 2024, whenever it's passed, those taxes would no longer apply. This would not affect any state estate taxes, so it would just be the federal estate tax that would come into play. Interesting bill, highly doubtful it will pass, but I just wanted to let people know that it is floating around out there. Okay, tax season, I always thought that this picture was hilarious of the Lego guy kind of getting ready, or in tax season, getting ready to go. But that's where we are right now. We're at the Wolf Group. We are gearing up for tax season. Everyone in the company is knee deep in tax trainings. We've been doing that all this week and then all next week, getting our folks ready to go and making sure that we've got all of our bases covered with the 2023 tax returns, form schedules, new laws, etc. As I indicated just previously, January 29th, so Monday, kicks off tax filing season, meaning that you can prepare a tax return and you can supposedly electronically file it. Now, I will note that it comes out, the IRS allows e-filing in tranches. So very simple tax returns can be filed on Monday. And then as the forms become complete and ready for e-filing, they allow more and more tax returns to be able to be e-filed. Non-resident tax returns, so for the G4s that are in the audience, if there's any, those always kind of come last. So the 1040 NRs normally aren't approved for e-filing until sometime in mid to late February. The due date this year for most folks living inside the United States is April 15th, and the extended due date is October 15th. So no more, this year as of right now, there's no more of the wonky April 17th, April 16th. Those dates are pretty much the same as usual. This is the due dates for estimated tax payments. So, quarter one, April 15th, quarter two, June 17th, quarter three, September 16th, and quarter four, January 15th, 2025. Okay, there is a lot of movement with legislation related to the net investment income tax. Specifically, there is the Christensen case, which is going to be on appeal or already on appeal. I believe it's already on appeal. This case, though, is a sister case from the old Toulouse case, which I think people, at least in my world, are familiar with. But Christensen is a very odd outcome because basically the holding in this case allows a U.S. taxpayer that has foreign passive income to be able to take a tax credit against the net investment income tax on that foreign passive income. So the net investment income tax is a 3.8% tax on passive income once your income exceeds certain thresholds. And it's a very interesting case because the placement of the net investment income tax on the U.S. tax return has always been in such a way that there is no way to take a foreign tax credit. And I recently did a presentation with one of the folks that actually drafted the tax for the Tax Cuts and Jobs Act, and their viewpoint was that this is a tax that cannot be offset by a foreign tax credit. It cannot be undone by a totalization agreement position. It is a tax that must be paid no matter what. And so the court here in Christensen is actually allowing a credit to be applied. And if that does hold, if this does kind of come to fruition, at least for the jurisdiction of France, you may be able to then use the foreign tax credit to offset the net investment income tax. You may also be able to, under the statute of limitations for refund, go back 10 years, right now that would be 2013, and get any tax you've paid back as a refund. Some people have actually talked to me about doing protective claims for refund, just in case this does hold up. So that is something to consider for the Christensen case. There is also this Kim case, which is an interesting case. It was actually talking about the totalization agreement between U.S. and Korea to see if you could take the net investment income tax out completely based on the totalization agreement. The court seemed interested in it, like they were open to the idea of it. However, litigation was withdrawn by consent of the parties, and so this case basically died a sudden death, and we don't know the outcome. There's no real outcome to report here, but I just want to let people know that that is also kind of being considered. And then lastly, Canada is now kind of following along. So we have a taxpayer out of Canada. It's basically saying, look, we saw the relief that was given in Christensen. We believed under the U.S.-Canada tax treaty, it's the same thing. So, and there's a lot of treaties out there that have the same clause that they use in the Christensen case. So now Canada in the Bruya case basically is following along, and we're monitoring very closely to see how the Bruya case will play out. Tax treaties. There's a lot of movement in tax treaties. So we have the Aresti case, which is a super interesting case for anyone that wants to read. Probably in my opinion, one of the most interesting cases I've seen in a super long time. But this is an individual who's held a green card since 1984. He's basically taking the position that he's a non-resident under the treaty, and then as a non-resident, he's not required to file an FBAR, even if he's a green card holder. That's called the treaty tiebreaker. We've always been told, the way that it's been presented to us through the rules and the law, is that if you take that position, while you may not be taxable on U.S. source income, foreign source income, you'd be taxable on U.S. source income. You still have to file informational reports like the 5471, the 8621, the FBAR. That's common knowledge. That's actually written into the FinCEN regulations that you have to do that, or in the preamble, I should say. But in this case, the court basically said, look, because you took this position, we don't believe that you're a resident for purposes of the FBAR filing. And basically they applied this 5-step escape hatch process to the analysis, and that's where their determination came in at. It's a super interesting case because there's a lot of things here that go against the way that the IRS and the law basically says when you take a tax treaty position. There's a lot of things that kind of cut against that. So this case is on appeal. We do expect the IRS to fight a lot of the issues in this case very closely. I mean, for example, the court here basically said that the exit tax does not apply to this client because Notice 2009-85 never got, basically time for notice in the hearing under the APA. And so under their interpretation, exit tax does not apply. They also basically allowed the taxpayer to file an amended return to go from married filing joint to married filing separate, which is also not allowed. But apparently the court was okay with that. So a lot of issues here. We're going to be watching this case very closely to see how it unfolds, but I wanted to make sure everyone was aware that it's out there. We have a new tax treaty. Believe it or not, Congress has done their job. I think we can all clap and give them a pat on the back. They finally allowed something to happen in the world of tax treaties. It's been a very, very long time. We have the U.S.-Chile tax treaty. This is a snip of the savings clause. So just for those of you that don't know, a lot of people believe that tax treaties for U.S. people are, you can use the entire treaty. The answer to that is no, you can't. Basically, if you're a U.S. taxpayer, you have to act as if the treaty does not exist subject to, that's the savings clause, subject to certain exceptions, which are the exceptions to the savings clause. Here are the exceptions to the savings clause for the U.S.-Chile treaty. And in particular, I want to point out the exceptions for pensions and Social Security. We have Article 18.1b, which is basically the growth in the plan. So under this provision, if you have a Chilean pension, such as an AFP, and you're normally subject to tax on growth on the plan if you were a highly compensated individual, that tax would no longer apply under this provision. So you can file Form 8833. Now, this only occurs starting next year. So for 2023, unfortunately, you got to put up with it. But for 2024, you can now defer tax on the investment in contract. Also, if you're a U.S. taxpayer living in Chile and you receive a distribution from a Roth IRA, that would not be taxable in the U.S. and it would also not be taxable in Chile. Okay. Article 18.3 is your general Social Security provision. I'm not going to go into that too much. But number 4 allows for in-country rollover. So normally, if you have a foreign pension and you roll it over in a foreign country, for U.S. purposes, if you're a U.S. taxpayer, that's fully taxable. There's no foreign qualified rollovers. The only way you get relief under that is if there's a provision in the treaty similar to the U.S.-UK treaty. Here we have one for Chile. So if you have a Chilean pension and you roll it over to another pension, it's not going to create a taxable event for you as long as that rollover occurs within the country of Chile. So you can't roll over a Chilean pension to a pension in another country, but if you roll it in country, you're fine. Okay. Lastly, if you're temporarily working in Chile or you're a Chilean resident temporarily working in the United States, and again, this is for a period not to exceed 60 months or 5 years, you can defer taxation of contributions to a retirement plan that's both employer and employee. Tax penalties. There's a ton of movement on tax penalties. Last year, I talked about the Farhi case. The Farhi case basically gave someone a pass basically took away the ability of the IRS to issue the $10,000 penalty for failure to file Form 5471. The IRS has taken great issue with that and been firing back a lot. On their appeal, they've pointed out numerous issues that they want to talk about. They've also said that they've been issuing the $10,000 penalty for over 40 years and never had this rejected by anyone before. So the IRS is taking this one very, very seriously. But it does kind of bring up the list of penalties that are assessable versus non-assessable, at least under the Farhi case. So on the right-hand side, if the Farhi case kind of holds up, then the IRS would not be able to assess penalties under those code sections, at least not under that case law. Congress may have to come in and do something about that. But on the left-hand side, if you have a foreign trust or you have a foreign partnership or something like that, that's still in the prudence of the IRS for their ability to issue those penalties. So for folks filing the forms 3520, 3520A, or the 8865, still be super careful that because penalties could be issued there. Okay. Speaking of penalties, the 2023 Taxpayer Advocate report came out. It's an awesome report. If you ever get the chance to look at it, the Taxpayer Advocate does such a great job at detailing all of the issues. One of the things that I thought was super interesting here is that when the IRS does issue international informational penalties, those are those $10,000 penalties like on the form 5471, a lot of those really go to middle to low class individuals. So taxpayers with an AGI of $400,000 or less, and if you look at the left-hand side of the slide, receive an average informational return penalty of about $235,000. It's a lot of penalties for someone that makes, $400,000 or less. On the right-hand side, the 6038 penalties, which are basically, on the top right-hand side, the 83% of business penalties, so the old Form 5471, 926, 8992 penalties, are against mid-sized to small businesses. So if you're operating a small business offshore and you just happen to get a penalty not filing those forms, pretty much 83% of those are going to small businesses instead of large businesses. And that may have something to do with who they use for tax preparation services. The report also detailed that one of the main strategies for the IRS when people fight penalties is to try to delay settlement within litigation for as long as possible. Basically, they're just trying to run the tab up on the client with their representatives. If you get to $80, $90, $100,000 to litigate a penalty, at some point in time you may just give up and then try to settle with the IRS and get whatever you can, because there's that line of demarcation, right? How much do you spend battling a penalty before you just need to pay it? And Taxpayer Advocate basically slapped their hand over kind of taking that position on a number of things. One thing I want to point out here, though, this is something that is super interesting. Out of all those international informational penalties, 84% of them get abated, believe it or not. That's a massive number. So if you've got a penalty for 5471 or 5472, 3520, 3520A, 84% of those were abated between 2018 to 2021. And what that means is not necessarily during those years they were abated, but for penalties that were issued for those years, the abatement over the last couple of years, mainly 2022, 2023, has been about 84%. Okay, we had the Bittner case, and for those of you that don't remember, the Bittner case basically came in and said that the IRS, it's a Supreme Court case, so it's the law of the land. It basically said that the IRS cannot assess a penalty on the FBAR by account. So for example, the IRS was trying to say, if you have one FBAR with 5 accounts, that's a $50,000 penalty. Rather, it's by form. So it doesn't matter how many accounts you have on your FBAR, it's one penalty of $10,000. The IRS understood the decision, but did not like the decision. And so what they did is they eliminated the FBAR mitigation penalty guidelines. So these no longer exist, which, yeah, I mean, it's a good thing for some people, but for people that have really tiny accounts, the $10,000 FBAR penalty is not applicable. Rather, as you can see here on the mitigation guideline, if the value of all of your accounts on the FBAR did not exceed $50,000, then you can mitigate that penalty down to $500, right? And I'm sure you'd much rather deal with a $500 penalty for small accounts than have to deal with a $10,000 penalty. So unfortunately, we no longer have the mitigation penalty guidelines. That's gone away. So it's $10,000. Doesn't matter if your account had, if your FBAR had, several accounts with a couple $1,000s or a couple $1 million, everyone gets the same treatment. The transition tax. So the more cases making headlines, a lot of people are just dying to know the outcome here. It's been a hot topic of conversation on every single conference and presentation that I've seen over the last couple months. This case is basically a challenge to the transition tax that was imposed on foreign businesses back in 2017. And I can tell you that if the Supreme Court rules favorably for the taxpayer, which is highly unlikely, that it will literally upend the Internal Revenue Code. So it's unlikely this is going to be a taxpayer-friendly decision. We're looking to see how this plays out. It was argued on December 5th of last year, and we'll get the decision. The Supreme Court always releases their decisions right around the end of June once they go on recess. So sometime over summertime, we'll know the outcome here. So more there to come, more and more. Okay, audit. So the IRS has got a lot of money from the Inflation Reduction Act. They've hired a ton of people. It's a huge push for them. They have basically on September 8th, they put out this massive kind of announcement and they're saying, look, we're going to draw a line in the sand and here are the people that we're coming after, and we're coming after them hot. Okay. So first and foremost, high income earners. So if your AGI is over $1 million and you have more than $250,000 in recognized tax debt, you got to make sure that your tax return has been done correctly. The people they're talking about normally on this slide, the 1,600 taxpayers, believe it or not, these are individuals that have not filed a tax return at all. And a lot of these individuals have W-2s with over $1 million on them, which is astounding to me that we have people in the United States that have not filed tax returns and have W-2s with over $1 million on them. But apparently that is the case. And they're not only looking to audit those individuals for just their W-2, but more so anything else that really touches them. So if they're owners of partnerships, beneficiaries of trusts, owners of C Corps or S Corps, they're also going to be auditing those business entities and taking a look at the information regarding those. They're going to be employing a lot of advanced techniques that you don't normally see under audit. So they're going to use data analytics. They're going to use risk assessment profiles. And they're going to use geographic folders or virtual case folders, meaning that IRS personnel anywhere in the world can work the file without having to have the file transferred to them in some kind of paper format, which is a big step forward for the IRS. But it does allow them to move a lot faster and together a lot more information. They've also listed the following topics as areas of concern for them. So foreign financial asset reporting, you can see that in the middle. Listed transactions, which conservation easements are the ones that most people know about, but we'll talk about the multi-pensions here a little bit later. So these are a slew of things that they're looking at. And then there was this updated. This just came out earlier this year, came out on January 12th. Out of the 1,600 people that I just talked about, they've already audited 900 of them. Those people have filed and they paid tax. And so they've collected $482 million. They're calling it the millionaire's effort. So they're already putting points on the board, and these things are already coming to fruition for the IRS. They've also kind of indicated, these are the people that, we're really going to try to push down on as far as the audits that we're going to do and the places that we're going to go. For FBAR, one big thing I want to notify to a lot of people is they are looking for people that are violating the FBAR filing requirements, but more so, they're looking for balances that average over $1.4 million. So that's in total. So if I've got, say, 6 bank accounts that, in total, the maximum reporting amounts were, say 1.425 million, you could be a target for the IRS for audit. They may want to reach out and confirm that you've been reporting your balances correctly. They're also looking for patterns of people that either have not filed or not filed correctly that have over that 1.4 million aggregate value. So be very, very careful with your FBAR filings because, again, the IRS got 80 billion or a little bit less than 80 billion, but they have to return a certain number of dollars back to Congress. I believe it's $7 for every dollar they get. So they're looking to get a return on their investment, and these are the ways in which they're going to do. Okay, Secure Act 2.0. So there's a lot of stuff that's kind of flown out of Secure Act 2.0 that is now applicable as of Jan 1, 2024. So if you own a business, for example, and you're going to put in a new retirement plan, there is a credit that you can get. So for example, if you have less than 50 employees and you're a small business, there's a credit that you can get under Internal Revenue Code 45 capital E for up to $5,000. If you have more than 50 employees, but less than 100 employees, there's also a credit that may be available for your business as well. So just be aware of that. Student loan repayments. So if you have an employee that's making student loan repayments, there is the ability for now an employer to match those student loan repayment amounts within a 401k, 403b. So if you are making student loan payments, you may want to reach out to your HR person and say, hey, are you guys going to be, matching my contributions to my student loan within my 401k? That's a pretty good benefit to have if your employer offers that one. There are now employer-sponsored Roth plans under Section 402 capital A. So there can be Roth 401ks that you may be able to access and get into. Again, employers can now match contributions to those, but there's a whole set of steps that have to be put into place for that. So you may, if you're interested in the Roth 401k or any of these other items, again, reach out to your employer and see if that's something that they're going to be considering. There's a new thing called an emergency savings account, which is not offered to what we call highly compensated employees. And I think at the highly compensated employee wage amount is $135,000 or $145,000 of wages. So anyone that makes less than those amounts can basically create now an emergency savings account, which the amount that you can put in there is no more than 3% of your wages or $2,500, whichever is higher. But basically, once you funded the account, you can make withdrawals from it anytime you want to. It's basically an emergency fund. If you don't use the funds, you can roll those over to a Roth IRA if you separate from your employer. You can also roll over 529 plans to a Roth IRA. That's a new thing that you can do. The plan's got to be a qualified tuition program plan that's older than 15 years. So if you have children that you set these plans up for that basically didn't use the funds, or you don't plan on using the funds for your children, and they do meet the requirements, the 15-year requirement, it may be something to consider for a planning function to roll over the 529 plan to a Roth IRA. There's a lifetime $35,000 aggregation limit, and it's got to be a trustee-to-trustee transfer. So you can't get the funds and then make your contribution. You got to have the 529 plan actually roll that over to the Roth IRA. Maryland, there's a special thing about Maryland 529 plans. I'll talk about that here later, but Maryland's got special things that you have to consider there. There's also going to be, it's not this year, it's going to be next year, actually at the very end of next year. So really this presentation 2 years from now, I might mention the long-term care insurance plans. These are going to be available to employees as well. They can fund these, they can fund them for themselves, their spouse, or their family. And once distributions are made from that, basically what happens is that one big thing to consider here is that if you're doing it for you and your spouse, you guys have to file jointly to avoid the 10% penalty on distributions. Hardship withdrawals. There's also a certain set of factors that you can take a hardship withdrawal from a retirement plan and not be subject to the 10% penalty, whether it's terminal illness, the victim of domestic abuse, an emergency withdrawal, or a federal declared disaster. I'll leave the slide up there with the sections. You'll be able to go back and check that out if you want to. FinCEN BOI. So I just did a presentation on this, not too long ago. It's on the Wolf Group YouTube channel if you want to check it out. But this is massive. Basically, anyone that owns an LLC with limited exemptions will have to file this report sometime within 2025. If you create a new LLC sometime in 2024, you're going to have to file this report. It's a brand new filing. And basically what happens is that this filing applies to any U.S. LLC or any U.S. company, corporation that files a document with the Secretary of State. So if you've created an LLC or you've created a corporation, you filed a registration form with the Secretary of State in any state within the United States, you'll need to file that report again before January 1st, 2025. If it's prior to January 1st, 2024, anything created within 2024, you'll have 90 days, and we'll go into that in a second. If it's a foreign company that's doing business in the United States and they have to be registered to do business, then they're also going to have to file as well. Okay. Now here are the due dates. And one thing I want to note here is on the right-hand side, it says for newly created companies, meaning on or after January 1st, it states 30 days. Well, I just said 90 days. Why did I say 90 days? Well, the FinCEN basically came out and said, look, instead of the 30 days for 2024, we're actually going to make it 90 days because it's a brand new report for just 2024. However, if you create a company after January 1st, 2025, it reverts back to 30 days, okay? So the 90 days is just a pass for calendar year 2024. For the company itself, you've got to report, these are the items that you have to report: full legal name, state of formation, current business address, and a unique identifying number such as an EIN. You also have to report information on the beneficial owners. So if you're the owner of the company, you've got to give your full legal name, date of birth, your residential address, and then a unique identifying image plus your identifying number. And so that image could be a copy of your passport, could be a state identification document, or it could be a state driver's license. If you don't have one of those three, but you have a foreign passport, you can use one of those as well. Okay, so it's a pretty significant undertaking that you have to do. If you don't do it, it could trigger a $10,000 penalty. So be very, very careful that you make sure to take the time to do the reporting for the FinCEN BOI if you have a U.S. LLC or if you have some kind of company. Okay, So miscellaneous stuff. Um, I spent a lot of time working and doing offshore voluntary disclosures, spent a lot of time in Zurich, when the IRS is basically doing a lot of their work with the Swiss banks, basically investigating them for hiding US taxpayer funds and helping US taxpayers, hide income and not report their foreign financial assets. And that time period was basically 2009 through roughly 2016, 2017. And it's shocking to me when we have here in late 2023 or 2024, when we still have this issue floating around. But here we go. We have again the Senate Finance Committee has done a significant probe on this, and basically we still have ultra high net worth individuals hiding very large accounts offshore, not reporting them to the U.S. government, hiding income offshore. It's a big deal. And so here we have Credit Suisse identifying, this is the first batch of my understanding, 23 large accounts of ultra high net worth individuals with over $20 million. So it's an issue that kind of continues to rear its ugly head. And then at the very end of 2023, we've had Bank Pictet basically enter into a deferred prosecution agreement with the Department of Justice after it was determined that they've been helping U.S. people hide billions in assets through what they refer to as life insurance wrappers, which is a terminology that the IRS simply hates. They despise the term life insurance wrapper. But basically what happens is a lot of folks do what's called private placement life insurance, which PPLI is still alive and well. It's an area that is going to be investigated by Congress and pushed down significantly on. But under the PPLI product, you basically can wrap a bunch of funds inside an insurance wrapper, potentially within a trust. And there are rules that some people believe help obfuscate income or the reporting of income or the reporting of assets. So I think there's going to be a lot of movement here in 2024 on PPLI and life insurance wrappers, especially now that they've identified millions and billions of dollars of assets that are being kind of hidden offshore. So be very well aware of that issue and that's floating around. Also, life insurance wrappers don't just happen within PPLI. It's a common thing throughout the rest of the world. So if you have, for example, a pension that has a life insurance component to it, that could be construed as a life insurance wrapper. There's also foreign life insurance that's funded by foreign mutual funds that could also be another example of a life insurance wrapper, and you need to be very careful with that. Malta retirement plans. This is still a hot button issue. We've heard a lot about this since the proposed regulations came out in the middle of last year. Basically, the proposed regulations, which are not yet final, we're hoping that we get some news on whether or not they're going to go final this year pretty soon. We do hear that there are some potential regulations that will come out that the IRS has been hinting at related to reporting of foreign pensions and Form 3520. So that's definitely coming out, we think, pretty soon. And we'll probably do a webinar on that when that comes out. But with the Malta stuff, we're super interested to know once the regulations go final. Because once they go final, there's kind of a 90-day window in which listed transaction reports have to be filed for all years that a Malta pension may be in existence for a taxpayer. That's a substantial undertaking in a very short period of time. And listed transaction reports have to be filed under Form 8886. This is a big boy. This is a big boy form. It triggers massive penalties up to $100,000 per form if you haven't filed it or not filed it timely. And there's a very special procedure on how to prepare the form, how it gets filed, what it gets filed with. There have also been, significant conversations about, okay, the filing of the listed transaction forms for someone that has a Malta pension is one thing, but getting back in compliance with all the other forms, 3520, 3528, all of that, there's like multiple ways to do that. Which one is the correct path? Will there be a program that the IRS will announce just for this issue? All of that seems to be kind of up in the air, although we have heard of several people that have already attempted to do streamlined filing, and we're keeping a close eye to hear back on the results of that, and if there's any issues that have popped out of that. Some people have also advised their clients, and I think these are more for the people that have actually done this very improperly, not roll over a pension, but putting in actual appreciated assets. Those people, my understanding, have entered a voluntary disclosure program and are disclosing their multi-pension through that program. So that is something that is floating around out there as well. Okay, moving on. I wanted to bring this to everyone's attention because every year at the Wolf Group, once we start e-filing tax returns, there can be what's called an e-file rejection, meaning that for some reason the IRS is not accepting the return as e-filed. It could be for a wide variety of reasons. I actually just learned the other day, and you learn something new every day, that if you obtain an ITIN, an individual taxpayer identification number, let's just say I just got that ITIN and I'm trying to file my 2023 tax return and I just received it, today. I'm not going to be able to e-file my return for 2023. I'd actually have to wait to e-file the return for 2024. So the first year you get your ITIN, you can't e-file. The second year you can. So I just learned that. But on this slide right here, these are the top 5 reasons that the tax returns get rejected for e-filing. And so I just wanted to bring to people's attention the reasons why returns seem to get rejected, or at least the top 5 reasons. And I will note that the birth date, people sometimes give birth dates in reverse. Remember, it's month, date, year, not date, month, year. And then some people, they put their name or their information in such a way that doesn't match their U.S. Social Security number. Remember that when the IRS matches your name and your Social Security number, it needs to match exactly to your U.S. Social Security card. And if it doesn't, then that may cause an e-file rejection. And so be very, very careful with that. Also, if you have an ID PIN, which a lot of people seem to have that, make sure that if you're using a tax preparer, or even if you're doing the return yourself, if you have that PIN, that needs to go on the return. That typically goes on to the bottom of page 2 of the tax return, has to be input there to allow it to move forward. Okay, IRS backlog. So a lot of these webinars, I've talked about the backlog. I've talked about the backlog for years. It seemed like the IRS had kind of gotten over the hump of the backlog. We talked that they had hit 35 million returns that were unopened during the pandemic, and it seemed like in 2022 that they'd gotten over the hump and we kind of returned back to normal, or best type of normalcy that we can get to. However, unfortunately, it's kind of reared its ugly head again, and paper continues to be the kryptonite of the IRS. And a lot of people have come to me and said, Mish, how long does it take for an amended return to get processed, or how long does it take for my paper filing to get processed? And I still tell people these days, with the backlogs and the way that they have things set up, it's unknown. And I would not take what the IRS says on the website. I think they say 6 to 8 weeks. I would estimate that more 20 to 24 weeks before it gets processed. I would also tell people that to check on your tax returns, make sure to get your IRS online account. If you don't know what that is, or you look it up or email me. But the IRS online account is fantastic. It allows you to log in. It tells you if there's any issues floating around with the IRS. It allows you to pull transcripts, which is how we know as tax practitioners what's going on with your IRS account. So I normally tell clients, hey, pull that IRS account transcript for the year or years that you have an issue with. Send it over to me. I'll decipher the codes. We'll talk about it. But that's a great way to kind of, do kind of an internal check and see what's going on with your IRS issues. I know it's a little scary. It's kind of like going to a doctor and getting a checkup, but I would tell you that it's good policy to do that on a regular basis. Check in, just make sure that, there's no audit or processing issues going on with your IRS account. And if there is, then you know that you need to take action and get something done there. And here again is a report from the Taxpayer Advocate on the processing time. This top line here talks about the processing time for amended tax returns. And they have here on average, it's 162 days in 2022. Okay. Calling into the IRS. So calling into the IRS, if you talk to the IRS people, they'll tell you that they've gotten so much better at this, that the wait times aren't as long. And basically the way that this is measured is called level of service, or LOS. And the people that you're talking to at the IRS, they're called customer service representatives. And as of July 30th, 2023, there was about 15,000 customer service representatives that work for the IRS. What they do with these folks, just so everybody understands, is that a certain portion of them will be answering phones, and then they'll rotate and they'll respond to notices or correspondence in what we call an IRS campus. And then they rotate again and they rotate again. And that's kind of how they rotate their staff to make sure that they meet the requirements for phone service and notice response. So it's not like there's a consistent person that answers the phones 24/7, 365 all year long. There's a rotation of these people in and out. One of the issues that we have here is their knowledge base. The real concern here by the taxpayer advocate is that, yeah, you've got people answering the phones, but do they even know what they're talking about? Have they been trained properly? The whole time on average is about 13 to 16 minutes, which is still bad in my opinion. Would love to see that get down to under 10 minutes. But just know that if you're calling into the IRS, you may have to wait, up to 20 minutes or so before you get through. And then what I would just say is be careful with the advice or the response that they give you. If you feel that it's someone that doesn't know what they're really talking about, then, trust but verify. It's going to take time for the IRS as they're rebuilding their staff. And I talked about this last year that, that they have a large amount of people that are going to be leaving or aging out for retirement or attrition. They're bringing in a lot of new people. It takes time for those staff members to kind of get up to date on IRS policy, process, tax law, all that stuff. It's a tremendous undertaking to learn all of that and be competent at it and be able to field phone calls and take random questions from people without much context. So just have some grace there for our folks there at the call-in centers. Okay, paperless processing initiative. I'm a huge fan of this. I despise paper. When, if we have the ability to do paper, if someone comes to me and says, hey, Mish, I want to file my return, paper file it, I feel like it's less risk of audit. I always tell people, no, I try to talk them out of it. I'm like, hey, it doesn't matter whether you paper file or you file it, the audit risk is the same. And e-filing is so much better to get the return on file with the IRS. There's less likelihood that they mess up the processing. IRS agrees with me, believe it or not. And they have come out with this initiative that basically says they're going to go 100% without paper by 2026. So starting for next year's tax season, they want to try to have as many filings go through e-filing as possible. I, for example, would love to see forms 3520, 3520A be e-filed. I think that's a painful process for all of our clients that have to file those manually. But we're looking closely to see exactly when this goes through and kind of what filings it will affect. But basically, we think by 2026, pretty much everything should be able to be e-filed to the IRS. There's also some talk at a conference I just went to about potentially giving taxpayers direct access to e-file their own tax returns. Right now, I think there's a free file application for very, very basic tax returns through the IRS website. And outside of that, you pretty much got to go to an option through, one of those big box providers or use a CPA or accountant. There may be a function, though, that they're considering where people will be able to directly file with the IRS. But the IRS wants to think that through before they allow that to occur. Okay, there's a simple notice initiative. So, for anyone that's received an IRS notice, if you look at the right or left-hand side, and I know that it's in small print, and I apologize for that, but that's normally, if you ever seen an IRS notice, that's probably what you're used to when you receive an IRS notice. It's a little block font, and it's kind of hard to read and hard to kind of process, and the eye doesn't like looking at it. So they're trying to make sure that the notices are kind of more intuitive, and they have QR codes and all sorts of advanced, sophisticated things. So there's this simpler notice initiative where they're basically going to update all of their notices to make them look cute and fancy. And so there's this pilot notice for the 5071C letter, which is the ID verification letter, which is a very, very, very important letter. So if you get this, please do something with it. Otherwise, the IRS will not process your tax return. And you'll come to me and say, well, look, Mish, they processed 2018, 2019, and for some reason they didn't process 2020. They processed 2021 and 2022. Why did they not process 2020? Well, you probably didn't verify your identity with them, and you need to do that. But keep that in mind that if you get a letter and it doesn't look like it's right from the IRS, it's not well, I guess it could be a fraudulent letter, but more likely than not, it's probably one of these updated letters under the Simple Notice Initiative. Okay, TikTok advice. And I know you're looking at me saying, Mish, what are you talking about? TikTok. Social media. Social media has exploded with people giving tax advice, whether it's TikTok, Instagram, X, which is formerly Twitter. Sorry, I'm not very big with all these platforms, so forgive me if I'm saying something wrong here. But what I would tell you is be very, very, very careful getting your tax advice on social media. There's this TikTok advice scam, and I don't really know how TikTok works. I'm not even sure how this gets out to people. But basically, according to the IRS got very mad about this. There was a scam going around saying, look, create this trust and you can make capital gains disappear, which was a faulty interpretation of Internal Revenue Code 643. If you've taken advice from social media on your taxes, you may want to just verify that with your accountant, or make sure you alert your accountant that that's where you got the advice. And I would just tell you, be real careful about taking tax advice from TikTok or any of the social media platforms or Chat GPT or any AI function. Like all of that still, it needs to be, that to me, that's all up in the air still. Like that's going to be a long time before those things are able to really give good, solid advice or be able to be very helpful, at least in the tax world. There's a massive art donation scheme. So basically what's happening is people are saying, look, if you buy, art, we're going to help you then, donate the art to get a charitable deduction. And a lot of times what happens is they arrange for everything to occur from, storage of the art, or maybe you already have the art, right? So they're going to arrange for an appraiser to come in, appraise the art. Then they're going to come in and say, look, we'll store it for you. We'll ship it for you. We'll get all the stuff done for you. And what they do is they basically inflate the fair market value of the artwork. And then the IRS comes in and challenges charitable contribution. Apparently this has happened a lot over the years, but the IRS is just raising the red flags on it now. So if you think you've had this happen to you, be very aware that you could be, and you try to claim a charitable contribution, it could trigger an audit. Digital nomads, this is a huge issue. So a lot of people are saying, look, I'm, from COVID. And I think a lot of employers are wanting people to more come back in the office now. But it has been my observation that people since COVID have said, hey, I'm going to work wherever I want to work, however I want to work. So I'll work in Italy for 3 months. I'll work in Florida for 3 months. I'll work in New York for 3 months, but I live in Virginia. There are a lot of digital nomads floating around out there. Estimates in 2022 have about 35 million digital nomads, of which about 15.5 million exist in the United States. The problem here is that you may create a multi-state filing requirement for not only you, but your employer. If you're working outside the United States, you may create a filing requirement in a foreign country for both you and your employer. There's also withholding tax issues, state law issues. So don't just think that you can run out with your computer and work for 3 months in New York or 3 weeks in New York or California. I mean, those places, they'll expect certain filings to be done there. Okay, this is a beautiful sunset picture, and no, it's not the end of my presentation, although I'm getting towards the end here. This is related to the Tax Cuts and Jobs Act of 2017. It is set to sunset on December 31st, 2025. If that happens, if no new law comes around to replace it or repeal it and put something in new, if it just we hit December 31st and we wake up on the new year for 2026, what will happen is that a whole host of things will change. It'll create havoc. It'll blow up the tax code in a wide variety of ways. But basically what happens is the standard deduction gets cut in half. The top tax rate jumps to about 40%. There's no more SALT cap, which I would personally welcome that. The mortgage interest deduction cap goes away, but it goes back to the pre-TCJ levels. Now you can deduct fees. So on the Wolf Group fees, you can deduct those on Schedule A. The child tax credit is cut in half. And that's why at the beginning of the presentation, I talked about the bill that's currently floating in Congress to make that permanent. So the sunset does hit, the child tax credit would still stay a large amount. Personal exemptions, which I'm not sure how many people remember those, but those would come back into play because, again, the standard deduction is cut in half. The corporate tax rate would jump from 21% flat rate to a 35% progressive rate. QBI deduction would go away, so bye-bye QBI deduction. And the estate tax exclusion would drop from 13 million, where it's at right now, to 5.4 million. And so basically everything that's going on right now in Congress related to taxes, as the quote says here by Ron Wyden, everything is about 2025. They're very concerned about the sunset of TCJA. And so there's going to be a huge battle gearing up in Congress over what happens there. Is it going to be, and it's probably going to have to be a bipartisan effort, my guess, but is it going to be repealed and replaced? Is it going to, be pushed forward for another 10 years with slight modifications? Is it going to be pushed forward, as is? It's an unknown out there, but it will affect a lot of people's tax positions, not only from an individual standpoint, but from a business standpoint. So I guess what I would tell a lot of people is keep your eye on this. There's a lot of change that will probably come out of this, and be very, very careful about making long-term planning decisions based off of the Tax Cuts and Jobs Act of 2017. Okay, state taxes. So the state of Virginia, this is every year I do this. These are the brackets for that are for 2023. Um, there was a rebate given to some folks that if you filed your 2022 Virginia tax return before November 1st, 2023, individual filers got a $200 rebate, joint filers got a $400 rebate. That is taxable at the federal level. So be careful if you got that. Make sure to include that on your tax return. There is a proposal, so that's the Virginia governor there on the right-hand side. He has a proposal right now to basically drop tax or cut tax rates for Virginia across the board and decrease them significantly. So we'll monitor that one very closely to see how that plays out. He's also proposed a higher standard deduction, so we'll see if that's going to take place or not. State of Maryland, here are the tax rates. Okay, for Maryland, one big new thing is that they now allow private letter rulings, which is super cool. And guess what? You don't even need to pay for these. You can get them for free. Maryland offers them for free. So if there's a technical question that you don't have an answer to, you may be able to do this private letter ruling request with the state of Maryland and get your answer to it. I would tell you, though, that if you are going to do a private letter ruling, you should engage an attorney to do the application and write up all the moving parts for you, because that's the best way to probably get your PLR for consideration with them. If you try to do it yourself, likelihood of them turning it down is probably very high. Okay, I said earlier about the 529 plan rollovers to Roth IRAs. This is a letter that several folks in Maryland wrote to the IRS about issues related to the 10% penalty with Maryland 529 plans. And so, believe it or not, actually, about 2 hours ago, the IRS just announced notice 2024-23. So when this came out, I immediately put it into the presentation so everyone could have this. But basically, as long as the Maryland rollover meets these three items, so those three criteria, then the 10% penalty does not apply for the rollover, and you don't need to file the Form 5329. Okay, so if you want to learn more about that, my advice to people is go download Notice 2024-23, check out the criteria, and make sure that you qualify for it to get that free rollover. Okay, District of Columbia, obviously super high tax rates there. Nothing really new to talk about with the DC, but I will note that the DC Commission has posted a ton of recommended tax changes for DC. You can go find those and look those up online, and you can kind of give comments about the way that DC does its taxes and its credits and all this stuff. It's all there and it's being considered. So if you ever want to learn more about DC tax, that's where it's at. Okay, and now I'll take questions. I've only got 2 questions in the Q&A, so I'll go through those real quick, and then if there's no more, then we'll call it a day. The first question says, if someone is going through a visa status change from G4 to H1 or green card and has filed an application who is still pending, what do you recommend the tax filing? Filing as a resident or non-resident? I would probably have to learn more about the situation to make that determination. I mean, for the G4 visa, your days don't count for purposes of the substantial presence test if you're a full-time employee of an international organization. So it really depends on kind of that fact pattern floating around, and also, what application are you making and where you're at in the process. So to figure out the filing status, I would have to know. Okay. This question concerns DC. Has there been any evolution in the way DC is handling highly questionable practice of imposing penalties and interest on those penalties, even when estimated tax payments are made timely and completely? No, DC is pretty tough on that. And certainly if you go back to the proposals there, I think there was one on estimated tax payments, but I think I think you'd have to kind of get that in front of them to be able to get consideration from DC about that. But to my knowledge, they love imposing those penalties and interest. They're pretty tough on it. It's one of the things I always try to alert people on, that they're even harsher than the IRS on estimated tax payment penalties, and to be very, very, very careful if you have to make those to DC, which is unfortunate. Okay, please say more about employers who can match an employee's student loan repayments to a 401k. Yeah, so I think the employer would have to offer that, and you'd have to look at the Secure Act 2.0 rules to be able to understand how that's going to work internally with the employer and how it's offered. I'm assuming that the employee would have to show the payments made for student loan repayments, and I think there'd probably be a difference between government repayments and personal loan repayments, although I'm not 100% certain on that. But I think that the employer should be taking the lead on giving guidance to the employees if they do offer that, and kind of how that works internally. But again, fantastic option, and hopefully a lot of employers will offer that. Okay, this question. What about foreign trusts indicated as subject to be covered? Do any changes not apply to funds within a foreign pension, such as UK SIP? There are no updates to that topic as of right now, but like I said, they're coming out with regulations, which I don't know what they haven't really indicated what the regulations are going to say. The regulations are a follow-up, though, to RevProc 2020-17. Basically, the IRS has been slapped over the hand for that not being given. You know, they came out and said this is going to give a lot of relief, but it turns out it was very narrow and didn't give any relief. And so basically, in lieu of that, they're going to try to put out regulations that hopefully help a lot of folks with the 3520, 3520As, and then the underlying assets that get reported in that, which is what the UK SIP would potentially have to file. But no movement on that quite yet. But when it comes out, like I said, we'll probably do a webinar that will address those regulations. Okay, what is the maximum gift one can accept from overseas into an account overseas without having to pay taxes on it? I'd have to learn more about that. Generally, gift tax is only imposed on the giftor and only on a U.S. giftor. So, for example, if I'm a U.S. person and I receive a gift from a foreign person, there is no tax on that. Also, I can't speak to how much can go into a foreign bank account, whether it's a gift or a transfer. That's not really a tax question, nor does it apply to the U.S. But would have to learn a whole lot more to understand the answer to that question. Okay, well, if there are not any other questions, and I will just kind of give it a second to see, then we will wrap up for the day. Hopefully everyone found this informative. Here's my contact information. If anyone has any questions, you're always welcome to shoot me an email, and I'm happy to get back to you. I will note, though, as I said at the beginning, we're all in training week at the Wolf Group, so we're kind of, it's kind of like going back to school where you have basically classes that you're taking all day, every day. So our schedules are kind of tight, this week and next week. So just be aware of that for any, a lot of people think, oh, there's nothing going on. You're in your easy season right now as we gear up for tax season, but actually this week and next week are quite busy within the company. So there may be a delay on getting communications back, but we'll do our best. And with that, I'm done for the day. So I appreciate you guys attending, and hopefully you found this valuable. Thank you.